Hello and welcome to UnHerd. I'm Freddie Sayers. You might have noticed for the past few episodes we've been digging into some financial stories, things that are a little bit more technical. And I think it's pretty important that we do that because otherwise what happens is these enormous stories happen, they get buried in technical language, no one quite understands them, they sound kind of boring, we just ignore them and move on, and meanwhile something really important has happened. The Silicon Valley Bank collapse, the bailout, or was it a bailout, that happened subsequently may have dramatic effects across the economies, not just in the US, but here in Europe as well. There's a guy I've really wanted to talk to for a while who happily is going to join to give a different perspective. His name is Matt Stoller. He is part of the American Economic Liberties Project, and he runs a hit blog called Big, which is all about monopoly power and why we should fear it and what we should do about it. He joins us from DC. Hi, Matt.
Hey, thanks for having me.
So we had David Sachs on, I think it was just 3 days ago. He was very worried about what might happen if there wasn't a big step by the Fed to guarantee all depositors. He was predicting potential bank runs from regional banks. And worse. And what he was asking for, he basically got, in that the Fed came in and said, no, we are going to guarantee all depositors and all deposits, which I believe includes businesses and individuals with no upper cap. You aren't quite as convinced as he is that this was a good thing. Is that right?
Yeah, they were just trying to scare the nerds in bow ties that control the world. That's not a technical. Sorry for being too technical. Yeah, look, this was just a panic. A bank did a crappy job at managing risk. So that their executives could make a lot of money. They were gambling with other people's money. They lost. And then the people whose money they were gambling with were freaking out. And they went to the regulators and scared them. And so the regulators made them whole. That's really all this is. And it's not like there was no, it was not it just wasn't, I mean, there might have been some problems, in a couple of other banks that were insolvent, but it is essentially just a banking panic. And instead of handling it like we should have, which is just let people who took risks eat losses, we decided to make them whole. And that's going to have really significant consequences.
Before I get onto the consequences, which I really want to understand your perspective on, let me push back a bit, because even if there was no contagion beyond Silicon Valley Bank, as I understand, they actually were the bankers for roughly half of the startups in the Bay Area, which is a lot of companies that are expected to make a big contribution to the American economy. If their deposits were just vanished overnight because they weren't protected by the normal scheme for retail depositors, are you seriously saying that would not have been a big deal, nothing to panic about? I mean, it sounds like it could have been kind of a big deal.
Well, I mean, if all their deposits had disappeared, yeah, of course that would be really bad. But the thing is that their deposits weren't going to disappear. These were uninsured deposits. And the FDIC, which is the federal government agency that insures deposits and then takes over and deals with bankrupt banks, is very good at what they do. If we had just gone through and let the FDIC resolve the bank as they should have, today, all of the customers of Silicon Valley Bank would probably have access between 40 and 70% of their deposits. By the end of the week, probably 80%, and in 2 to 4 months, maybe they would have had access to all of it. Maybe they would have had to take a slight haircut. This was not a big deal. Silicon Valley Bank lost some money, but they didn't lose it all. It's not like they were lending. This is in 2008. It's not like they were lending to random mortgage, people who couldn't pay back their mortgages or betting on weird derivatives on synthetic instruments. They bought treasury bonds and they bought safe mortgage-backed securities, and they took interest rate risk and then lost. But they lost their capital. They lost their bondholder money. But their uninsured depositors probably would have been fine if we had just gone through the regular resolution process. But the Silicon Valley sort of stakeholders and the regulators freaked out and decided that they were going to backstop the entire banking system and allow banks to just get essentially what are government guaranteed deposits. and gamble with it. And that's what they just did.
So the argument against what you've just said, which is what David Sachs was putting forward, is even if it ended up only being a slight haircut, as you call it, basically you get 80% or 90% of your deposits back at the end of a longer process, the ripple effect of confidence would be that there are 5,000 banks in the US, only 4 of them are part of the big 4 that are officially considered too big to fail. His prediction was the obvious effect would be everyone would be shifting their bank accounts to one of the big 4 because, okay, 15% may not sound a lot to you, but to a startup company, that's a lot. Why take the risk? Everyone, there'd be this. So in effect, he was making a populist argument, and that's how he was couching it.
No, he wasn't. I mean,
he was trying to say, otherwise there's going to be this aggregation of power in the big 4. Why is he wrong?
No, look. Okay, first of all, it's not like the uninsured depositors were innocent, naive types. Like some of them were. But, Silicon Valley Bank had stakes in 3,000 different companies. They were, if you put your money into Silicon Valley Bank and an uninsured basis, you got what was called white glove financial or white glove service, which is below cost mortgages, below cost lines of credit. And I'm not even talking about if you put your personal money. I'm saying if you're a venture capitalist like David Sachs, or you are a founder and you put your firm's money or the money of the firms that you invest in, which isn't your money, but if you put that money in, then you personally get access to benefits, which it's essentially sort of quasi bribes. So they were taking risk because they were getting a return on it. So it's not like these people were innocent, right? They took risks. They knew they were taking risks. I mean, it's not a secret that is a $250,000 FDIC deposit insurance limit.
So you think all depositors were taking a risk that they should have known more about?
All uninsured depositors, I mean, it's right there, right? When you open a bank account, it's right there. The FDIC it's very clear. And there are cash sweeps. You can use a cash sweep if you want, $1, $2, $3, $4, $10 million worth of FDIC insurance. Like they just didn't want to. And that's because Silicon Valley Bank were giving them benefits or because they were doing bad, risk management. I mean, it's just, so the idea that everybody would freak out and go to the too big to fail banks. It's like, well, there are many options aside from that to keep your money safe if you want to. And the point of what David Sachs was doing was trying to scare the regulators, I guess, successfully to make the people whole who were taking these sort of silly risks. And so like, I don't buy it. And I also think that, we have to break up the too big to fail banks. Like it's a really big problem that some of the banks are government backstopped. We should also just have a government bank. I mean, if we're going to have unofficial government banks, why not just let people open an account at the Fed if they want to, and just use that for safekeeping. You could also say that if you could create a special deposit insurance for payroll, right? So if you're managing payroll, you get special insurance from the FDIC so that there isn't any kind of freeze on that. So there are all sorts of things that you could do here. But what they chose to do is they chose to give the full faith and credit of the United States to every regional banker in the country. And, that's just a really bad idea. Like you don't want to give bankers access to taxpayer money that they can gamble with. It's a bad idea. And the irony here actually about the too big to fail banks is that, look, I worked on Dodd-Frank. It was a crappy law. We knew it was a bad law when we were writing it. It was embarrassing. I'm still embarrassed about it. But, one of the things it did do is it put higher prudential requirements on the big banks. So when JP Morgan wanted to do the same thing that Silicon Valley Bank wanted to do, they couldn't. And so JP Morgan is in a strong position, not because they're too big to fail, but because they're actually regulated and they had to have more liquidity on hand because the regulators told them to. So this is kind of like all sort of stupid and very irritating and just like one more justification for this like entangled corrupt system and policymakers who want to, who are just afraid of their own shadows. It's like, it's time we get over this. If you take risks, you have to eat the downside when things go wrong. I mean, that's just the reality here. And there wasn't even that much downside. I mean, it's just, all of it is embarrassing. And
but for someone, I guess, for someone who campaigns very successfully against monopoly power, do you not think in order to have a vibrant banking sector, you can't have one set of rules for the big guys, i.e. your money is going to be safe if you deposit there, and a different set of rules for the little guys, because the little guys are then at a disadvantage.
You don't see David Sachs saying, let's break up the big banks. You don't see all of the people who are saying we need a bailout saying, let's break up the big banks. We've been saying break up the big banks for 10 years or 15 years. We pushed really hard to break up the big banks in 2010. And, not with any help from Silicon Valley. Like all the people that are demanding a bailout now, where were they? They are absolutely protecting their relationships with JP Morgan, or, because they want to bring their companies public or they want to arrange for private financing. I mean, that's what this is just a sort of a broad class of people who protect each other. And if you want to deal with the problem, like, why not say, okay, we need a bailout and then we need to break up the large banks so they don't have a competitive advantage, which we should do because obviously all the rules in Dodd-Frank say that there is no too big to fail. We have something called the Financial Stability Oversight Council, which is a group of all the regulators, and they're supposed to look at any financial institution that might be problematic, and they actually have the authority to break up banks. So they could do this if they want to. And we all pretended for 15 years or 10 years that the banking system was stable. We had these stress tests, all of which is obviously garbage. If the 16th and 40th largest banks in the country, when they fail, it's a systemic risk event. This is a fragile banking system. I don't actually think it's that fragile. I don't think they had to bail them out, but they themselves acknowledge this is a fragile banking system. So let's go in, use the authority that exists in Dodd-Frank to restructure the banking system, which includes taking apart the large banks, but also means tighter regulation on the regional banks. And look, if we want a real banking system that isn't socialized, which is what we've just done, then we need to actually make that happen.
What is the world as it should be then? Because in a way, every bank is kind of a magic trick, isn't it? That we know that even with multiple stress tests, if everyone withdraws their money at the same time, that's going to be a potentially existential problem for the bank. So you need a bit of that. You need a bit of that feeling of confidence. Otherwise, this kind of stuff is going to happen all the time. That's where the Fed stepped in. If what you're suggesting is
only for uninsured deposits, right? And most banks are not. I mean, there are 5,000 banks in the U.S. Most of them are not financed with uninsured deposits. They're all mostly going to be fine. And then the problem with Silicon Valley Bank isn't just that it was illiquid; it's that it was insolvent, or might probably insolvent.
Uninsured deposits just means that it's companies, not individuals, right? Or what?
No,
what
uninsured
what
deposits means everyone gets access to. When you open a bank account, you're protected up to $250,000.
Right. As an individual,
you're not.
As an individual,
or a firm, a small, and you can get more insurance if you want. There are ways to do that. So, but if you don't, then that deposit it's called an uninsured deposit.
But so I guess the world as you would like it to be is one with lots of smaller banks and people taking a more calibrated risks. Maybe they're depositing in multiple banks and they're taking separate insurance policies in case one of them fails, or what does it look like?
So there are a lot of different ways to organize a banking system. But what I want to see is some market discipline in the system, right? So banking is inherently a public enterprise, which is why we have deposit insurance, why we have lender of last resort facility, and the way that you deal with that is you either allow some market discipline in the form of haircuts for uninsured depositors and bondholders and equity holders, and you also have aggressive banking regulation to prevent bankers from using essentially government guaranteed money to gamble with, or you create,
which is kind of what we thought we'd done, right? That first option is what we were told had happened post 2008, roughly.
I mean, no, because yes, it's what people sort of pretended, but de facto everybody understood that the too big to fail banks were government. They were government banks. They just weren't paid. The civil servants there were paid like they were taking actual risk and doing risk management, even though they weren't. So that's like the fundamental problem is that we established a group of government backstop banks, but didn't treat them like they were government backstop banks. So that's the issue here. It's like we have a public utility system, only we don't treat it like a public utility. So the answer can be go away from that and break up the banks and make sure that you don't have these banks that are too big to fail, and allow for a lot more sort of risk management on the part of people that hold cash. You could also go the other direction and just say socialize it all, which I don't think is a good idea. Or you can kind of like have a mix, which I think it probably makes some sense, where you take apart these banks, you make them much less fragile, and you regulate them more aggressively. But then you also establish a like the big banks have an account at the Fed where they can do they can manage a number of different facilities, but it's risk-free. If they have cash, they can put it at the Fed. You just allow everybody to have that capacity. We used to have postal banks in the United States. There are a lot of countries that have government banks. If you just want a place for safekeeping, maybe to manage payroll, and you're a business or a municipality or a nonprofit, whatever, and you want to put it somewhere and pay a small fee just for safekeeping, we should allow people to do that at the Federal Reserve instead of having, government banks that we call JP Morgan or Bank of America or whatever. And so that's kind of this. I would take apart a lot of these banks so you have more banks that are closer to communities, and you allow for some risk management, and that would also establish a place for safekeeping that we already have, but only for the big guys.
The net effect of all of that would probably be the closure of a lot of small banks, because as a customer, you're just going to kind of go for what seems like the safest option, and would be a huge growth in people depositing or banking directly with the Fed, which I think my guess is some of our more sort of anti-establishment viewers might be with you up to the first point, like break up the big banks, it's a bit of a stitch up. But then when you start saying bank directly with the government, a lot of people will be a little bit spooked by that, because you feel like the government has enough control over your finances. You don't want to just hand it straight to central government.
Well, most banks, most people will stay with their bank because they're guaranteed up to $250,000, and then they can do cash sweeps if they want more. And those banks often provide additional services. There are, relationships with bankers. So, that it's a relationship business. So I don't think there's a reason to imagine that those 5,000 banks are going to go out of business. What you will see is that some uninsured depositors, if they get frightened, instead of empowering JP Morgan with cheap uninsured deposits, they'll just go to the Federal Reserve, and you won't have any problems. It's not, I don't think that you're going to see this massive transformation. It's just that if, you're a municipality and you want to keep your money somewhere, you can do that if you want to. I do think that, look, I'm not a libertarian. I'm a populist. And at some level, the government is just, all banks are basically, they're chartered by the government. They are inspected by the government. They have access to a whole financial safety net that is provided by the government. So, this isn't a huge step change in how we see things. It does get away from this illusion that we have that the banking system is kind of private and just acknowledges that it's not. But I think that's an illusion. So I don't really see a reason to
talk to us about what's just happened, because the intuition that a lot of people have is that somehow the bankers are always getting rich out of whatever the situation is. And whoever there was rumors of money being withdrawn from Silicon Valley Bank by directors in the days before. I don't know if that's true or not. There's this.
Well, they were handing out bonuses hours before the FDIC guys were going in there. Right. So it's not, this isn't like, it's not hard to see what's happening.
Paint the picture then. Who has got rich out of this?
So who's gotten rich out of this? First of all, obviously Silicon Valley Bank executives. They were told in 2020, their own employees were going to them and saying, hey, we just got a huge influx of deposits. We need to go into shorter duration bonds to manage our risk more effectively. And management said, nah, we don't want to hedge. We prefer the profits, which is, as many of your viewers probably know, that's just classic, picking up nickels in front of a steamroller. Only the thing is these executives, they were getting bonuses based off the cash profits, even though that's not really a profit. That's just what is left over after you pretend there aren't going to be future losses. But if they get paid off of that, then you're going to have this poor incentive structure. So the Silicon Valley executives obviously got rich, and then there's same with the signature bank types, and then to the extent that you see this kind of behavior at other banks, which is unusual. I mean, let's be clear about something. Signature and Silicon Valley were financed with uninsured deposits at an extreme level, and almost no other regional bank is like that. I mean, you have First Republic, but about 65% of First Republic's deposits were uninsured. 90 to 95% of Signature and Silicon Valley banks were uninsured. And so that's, this is not a common business model. But
do you think we'll find out, by the way, Matt? Do you think we will find out in time the inner workings of banks like these? I mean, will there be emails? Will there be depositions? Will we find out
they're investigating
who said what? Why did this happen? Right.
They're investigating right now, and they're going to, potentially bring insider trading charges against the CEO, Greg Becker, who was selling stock a couple weeks ago. I don't think they're going to get away with what they did, but I wanted to say there are other stakeholders that are going to do well here. I mean, I think a lot of the Silicon Valley stakeholders that were getting white glove service, they were made whole, and they were getting all sorts of benefits, not as much as the Silicon Valley executives, but they got made whole, which is a huge subsidy.
So this is the idea that like a venture capital investor who has maybe 100 different investments in 100 companies will be pointing all of their companies to Silicon Valley Bank and will get some kind of benefit from that. Is that what you mean by the white glove?
That's right. And so, I don't know what kind of arrangement Mark Cuban had with Silicon Valley Bank, but he had $8 to $10 million, sitting in a deposit account there. He probably would take a 5% haircut. It doesn't really matter to him, but that's still a significant subsidy to somebody who, was taking risk. And everybody knows, Mark Cuban knows that, like he knows risk management. And same with Roku, who had $500 million of cash in Silicon Valley Bank, or Coinbase, which had a couple $100 million with Silicon Valley Bank. These companies, they would have taken a small haircut, but they had risk managers. They should have known better. So they're gonna do well here. And then the rest of the banking system, I think, a lot of banks would have had to manage their risk more carefully, and they would have had to focus on ensuring the safety of their uninsured deposits. And now they don't have to. And so this was effectively a large subsidy to the rest of the banking system, particularly the regional banks that would have had trouble and now aren't going to have trouble. And I don't mean trouble in the sense that they would have had a bank run, but trouble in the sense that they would have been forced to take less risk to make sure that they had enough collateral on hand to deal with any deposit demands that came in.
So this is the really big effect, isn't it? Because Silicon Valley Bank at the end of the day is just one bank, a significant one nonetheless. But the ripple effect on the rest of the 5,000 banks we're talking about, right down to smaller regional banks and others, must surely be, okay, ultimately the Fed is going to step in, so we're going to be fine. So they will be incentivized to be more risky, or they'll feel we can take bigger risks, whatever the rules allow, because we're going to be kind of bailed out.
So I would sort of, one part of that I would quibble with, which is that you have the too big to fail banks, right? Which we all acknowledge is a problem. And then we have the regional banks, which are, between 100 and $700 billion of assets. And there's some of them, but they're not that many. And they're the ones that would have had some problems here. Then you have the banks that are smaller than that are financed largely by insured deposits they don't benefit from this. And they are not backstopped. So the FDIC has no problem going in there and like wiping them out, because it wouldn't be a systemic event if you have a small bank that has some uninsured deposits. Like, those guys are kind of screwed because they're not big enough to worry the regulators, and they're not politically powerful enough to worry the regulators. So what you're actually doing is you're probably crunching the US financial system from a system of 5,000 banks to one that will have maybe 200 banks. So like the community, you got to distinguish between the community banks and the regional banks. And this was really good for the regional banks and really bad for the community banks.
There's this one detail about insured deposits that I just want to get to the bottom of for our viewers. When you talk about a large percentage of uninsured deposits, that makes it sound like a kind of risky situation. Does that in effect mean lots of smaller depositors, people who are below the 250,000 threshold?
Yeah, that's right. So the community bank is mostly financed with smaller depositors. And I mean, and to be clear, having a lot of uninsured deposits it's not a big problem if you have reasonable risk management on the other side, because if all of a sudden those depositors decide they want to go, if you have enough collateral, you can go to the Federal Reserve or you can go to the federal home loan banks and you can give them that collateral in return for temporary liquidity and honor the depositors until the bank panic is over. The problem with Silicon Valley Bank is they just didn't have enough collateral because they had made some bad bets. So it's not like uninsured deposits are you're more vulnerable to a run, but the issue really here was solvency of Silicon Valley Bank, not the fact that they were vulnerable to a run. The run was a function of the fact that they had big losses.
What do you think happens next, throwing this forward a bit? Is this the end of an episode, or do you think it's the beginning of a longer and more serious period in financial stability?
Well, it's a really interesting question, and I mean, I think you saw this in England in a different way with the Liz Truss and the pension funds that had really serious problems, and it's the same dynamic where you've had really low rates and tight and loose financing conditions, and now we're moving into back to sort of a normalized world, and all of these structures that were built on low rates are under stress. And the reason that we have to tighten financing conditions through both quantitative tightening and higher rates is because of inflation. And now things are starting to break that the regulators are very concerned about. Now, does this mean that they're going to give up on their fight against inflation? And I think that's really that's what's interesting here. And this was what there's a Federal Reserve governor named Tom Honig who had been warning against doing quantitative easing for 10 years and saying zero interest rate policies are dangerous because you're creating all sorts of fragility in the system. And when you have inflation, either asset inflation or just inflation of goods and services, you won't be able to deal with it. And that's the situation that we're in right now. So I am really worried about a reacceleration of inflation because you're seeing like Bitcoin is going up, crazy. The stock market is doing really well because, once these guys realize, okay, we've gotten bailed out, where our balance sheets are fine and our liabilities, got taken care of, we can go back to speculating, and that could fuel an inflationary fire. If regulators, come in and say, no, you're not going to do that, you can potentially take care of that. But,
so does that mean really think you want to see more interest rate hikes, or at least you don't want the Fed to go soft on inflation?
No, I think the Fed needs to go hard on inflation. I think it needs to tighten and engage in more quantitative tightening. And if the banks, if the whole banking system has serious problems as a result, which they don't right now, but they could if this continues, then we may need capital injections into the banks and a restructuring of the banking system. Because either you've got to deal with inflation. If you don't deal with inflation, then you're going to have very serious political instability. And if we have a fragile banking system, then we're going to have to address that. It's like, are you going to maintain the stability of the banking system and allow inflation to run wild? I mean, what's the choice that you have to make? And I think, I'm really interested to hear how the regulators think about this, because most people think of inflation as coming from too much government spending or too much, lower interest rates, people get enticed to borrow. But actually, Hyman Minsky noted that inflation comes from bailouts. When you bail out financiers who are engaged in money creation through speculation and lending, And they're, when there's a credit crunch, if they get bailed out, then they go right back to that and sort of supersize it.
Which is also why this question of populism and politics is so important, because people are really pissed off. What you just described is pretty much what happened in 2008. It was reckless decisions, and then there were bailouts. The rules didn't change enough. Meanwhile, we had this weird long period of quantitative easing, minimal interest rates that a lot of people did very well out of, people mainly with assets as opposed to people without assets. Now here we are in 2023, there's another confidence crisis, another screw up by a bank, another what looks like to be a bailout. And from what you're saying, it feels like people with assets, people in the banks, people making bigger financial speculation are going to be the winners. And the people who are going to have to pay at the end of the story are ordinary taxpayers.
Yeah, I think that's one possibility here, and it seems like that's what they're kind of leaning to. I mean, Janet Yellen and Jay Powell have kind of learned their politics, and their ideology is to preserve asset prices kind of at all costs, right? So the reason they got scared is because they were worried that there would be a reduction of asset prices. And so they said, we have to backstop the banks, otherwise you will see a credit crunch, instead of recognizing that sometimes that's what you need. And you can't just maintain artificially high asset prices or politically maintained asset prices if you want to have, and then, later on, tax them down a little bit or do a little bit of just redistribution here. It fundamentally distorts the productive capacity of an economy. It overweights the economy towards speculation, towards the financial sector. It underweights making things and doing real business and commerce. And so that's what we have now is a society, at least in the U.S., and I think you could argue it's a global dynamic, where it's a very sort of finance forward mindset. Like, our economy is run by central bankers, and we need an economy that's run by people who make things, as we saw during the early stages of COVID. You can't print medicine, like you can't print plastic bags, you can't print the physical things that we need to keep ourselves alive. And the more that we focus on preserving asset prices and preserving the primacy of finance, the less emphasis we're gonna put on maintaining the stuff that actually keeps us healthy and safe.
Final thought for you here, which I guess is a broader philosophical one. Who are the good guys? Where are the people to be excited by? Because we had a Republican administration in the US. Equities went through the roof. Now we've got a Democratic administration. Equities are still doing pretty well considering the turbulence. And as you said, this administration just done, basically prioritized banks, assets, and are too scared to take any action like that. Meanwhile, we have an ex-Goldman Sachs banker as our prime minister, and clearly he views the world in a similar way. Who is going to change this? Or is it just on a kind of conveyor belt to more of the same?
Well, I look at, so I think that Senator Elizabeth Warren is one of the good guys here. I mean, she's been pretty aggressive about saying that we need to break up the big banks, we need tighter regulation. And, she's basically been right about a lot of it. I know a lot of people don't like her, but, if you look at the policy just on banking, she's been correct on pretty much everything that she said. And so, and there are other...
Was she against this bailout?
I don't actually know if she was against this bailout, but she was against the 2018 deregulation bill that allowed Silicon Valley Bank to put this forward. She was against, she was pushing for the breakups in 2010. I'm sure she would be seeking FSOC to break up the large banks. I'm sure she's written letters on that. I mean, generally speaking, that's kind of...
Okay, so Elizabeth Warren...
That's what she... Sheila Bair just came out with an editorial in the Financial Times saying, we didn't need to bail out these banks, or if we did bail them out, then there's a substantial amount of fragility. I mean, I think Tom Honig, who's a former FDIC vice chair and board of governor of the Fed, I mean, he's pretty heroic for speaking out the way that he has. And I think that you see a lot of good work around, I mean, this is a different area, this is what I focus on, but in antitrust action to try to constrain the size of large corporations, not necessarily banks, but I mean, there are, they do handle banks as well. But, so you see like there's a lot of different parts of the bureaucracy that that didn't want this. I mean, I think if you look at the FDIC, like the Fed were the ones that were pushing this. They were pushing this bailout in Thursday evening, and the FDIC was coming in and initially made the right decision to liquidate the bank. And then by Sunday, they were pushed back by a bunch of policymakers. So there was a debate within government. And I think you saw, Republican Senator J.D. Vance, 10 days ago, the Republican senators all wrote on the banking committee, all wrote a letter to the Fed being like, don't regulate the banks aggressively. And J.D. Vance wasn't on that letter. And that was very, telling. So what you're seeing is a kind of rethink.
Right.
Yeah, there are strands. There's a sort of a rethink of how we do policy. And I don't think that you're going to see the same sort of confusion after the financial crisis or after this crisis that you did after the financial crisis. I think you're going to see a lot of skepticism and a lot of confidence, people saying, no, what you did, we don't agree with. We think that's a problem. And you're going to see some real pushback on what these policymakers did, which I think will be helpful. So I'm not a pessimist here. I'm very angry about what they did. But I'm not a pessimist. And then I think the other thing that
could I just ask, do you think in that coalition, there are kind of left-leaning voices there, such as Elizabeth Warren, who are obviously comfortable with state power, and then there are right-leaning voices like J.D. Vance, who are also comfortable with the state using its power to break up big corporations. What about libertarians? I mean, Vivek Ramaswamy is someone who is running for president. He's a kind of libertarian, I guess. He's been very opposed to what David Sachs was saying in the last few days. Do you think the libertarians will be sort of paradoxically added to your cause here?
No, I don't. I don't take them seriously. I think that they are, I haven't. So if you look at sort of the center of libertarianism in DC, it would be the Cato Institute. If you want regulators who are going to stand up to the banks, then you're going to need to there was a very clear choice. In 2018, there was that bill which, Cato Institute supported, and Sally Omarova, who was a professor at Cornell, she opposed it. She opposed integrating crypto into the financial system. And then Biden nominated her to be the head of the Office of Comptroller of the Currency, which is a very powerful bank regulatory agency. And the libertarians went crazy opposing her. And she ultimately was defeated because of her opposition to the 2018 bank regulatory bill. If she had been there, she would have been one of the voices, maybe one of the only voices saying, don't bail these guys out. So I don't take libertarians seriously because they don't have a track record of actually supporting tough regulators who are willing to make tough decisions. They have a track record of supporting deregulation and letting bankers do whatever they want. And then they whine about things like FDIC insurance that they know aren't going to be repealed. And then when a bailout happens, like afterwards, they say, we didn't like that. I don't think they're serious. And I don't think the idea that you can do something without state power is a coherent idea. All of banking exists because of state power. The question is not whether to use state power. The question is, how are we going to structure these markets? How are we going to write rules to structure these markets through public institutions? There is no free market that just makes these things happen. That's never there's no free market that grants a bank charter. A government does that. And so if you can't accept that basic dynamic, and I don't think Vivek can, then I don't take you seriously as somebody who has a coherent view of the world.
Final question. I know I said the last one was my final question, but I'm sneaking in one more here. Do you think this will result in more populist politics? Do you think people will be radicalized, people will be angry about what they perceive as yet another financial stitch-up where rich people win and the taxpayer foots the bill? Do you think that's going to happen?
I think it depends. I think it depends on decisions in the next couple of weeks about, whether regulators are going to allow inflation to go wild so that they can preserve the value of financial assets. If they do, then you're going to see I think a really substantial populist upswing. I know that my friends in all over the government are furious, absolutely furious. And the people who've been saying, don't let banks do this are absolutely livid. So I think that you're going to see a redoubled commitment to, to reining in these banks. But I also think that Silicon Valley is going to be in, political trouble from this, because people have been saying, oh, it's the big guys, it's Google, it's Facebook, it's and that are the issue. But now, they're going to be tagged with the scarlet letter of bailout, right? And I don't think they realize that, but that's just, no one will ever forget that Silicon Valley got bailed out. They're just not going to forget that. And that's going to cause them political problems going forward.
Matt Stoller, thank you so much for your time today.
Hey, thanks so much.
That was Matt Stoller. Thank you to him for a very different view. We had David Sachs on a few days ago. He had one view, which is that the bailout absolutely needed to happen. Unless people feel confident in the banking system, the economy can't function. This wasn't a realistic choice, and he sometimes describes as a libertarian, so that was interesting. Meanwhile, Matt Stoller there, a real expert on monopolies, on how large corporations end up kind of enmeshing with government and just benefiting. He had some really interesting things to say. I'm not sure exactly who was right, but I hope you are nonetheless informed. And we'll see you next time. This was UnHerd.